Today, we're going to talk about net unrealized appreciation. In other words, NUA. Now, what is this? Well, it's something you could do with your 401k plan with your company stock. So if you have company stock in your 401k, you might have a unique opportunity to pay less taxes on that money using the NUA. So let's get into it on how it works. So we're going to take a stock, right? Stock A. And imagine you work for this stock A company. And when you bought the stock throughout the years, right, you bought it at a low cost basis, or a cost basis of, let's say, around $50 a share. And now, when you're retiring, you're leaving the company, that stock is now worth $100 a share. Well, there's something called an NUA, where on the appreciation of the stock, instead of paying ordinary income rates, you can now pay capital gains rates. And it really all depends on which one is lower. All right, so if you're retiring and you're in a higher income bracket and you spend a decent amount of money, and you know, hey, on the top end, I'm probably going to be in the 22% tax bracket. Well, instead of paying this 22% tax right there, you can pay capital gains at 15%, for instance, saving you that 7% in taxes. Okay. Now, this can make sense for a lot of people. Depends on what you're doing. Now, for some people, capital gains rates could be zero. If you make less than $96,000 a year, $94,000 for 2024 as a married couple, then your capital gains rate is 0%. So depending on what you're spending in retirement, if you're in this really low capital gains bracket where it's zero, and you're spending 60, 70K a year, there's a really good chance this NUA thing might help you a ton on your taxes depending on your situation. So net unrealized appreciation basically says you can either take the ordinary income, like taking money out of your 401k, like normal, or you can get the stock out of there. Okay, you're going to pay taxes on the gain, on the basis, ordinary income. So you deferred that tax out. But the appreciation that you made on the stock could then be taken as a capital gain instead, which could be a very large tax savings depending, right, on the person and what you're doing within there. All right, so a very cool strategy that could make sense for you, or it could not. But it's something worth looking into, especially if you have a lot of stock and it's appreciated a lot over your time there. Now, we've had clients who are at companies like, for instance, that have went out like Tesla, Amazon, Apple, right? Your big companies out there that have seen a lot of appreciation over the years. Well, it can make a lot of sense to actually use this strategy to pay less taxes on it later on if it'll put you in a lower tax bracket. So if this is something you want to learn more about, definitely give our firm a call. We're more than happy to help you out. Check out our website out below.